Cell 1. In this cell, we explore the concept of confidence thresholds and decision bands, which play a vital role in stock trading strategies. These tools help traders determine when to execute trades by ensuring that signals have enough reliability to outweigh transaction costs, slippage, and market noise. Essentially, they establish a no trade zone for weak signals, promoting more disciplined trading practices and reducing the risk of overtrading. The logic behind confidence thresholds is centered on measuring a forecast distribution rather than relying on a single estimate. For instance, by evaluating different quantiles, such as the P10, P50, and P90, traders can gain a more nuanced understanding of potential outcomes. This approach not only encourages mindful trading, but also transforms abstract feelings, like a gut instinct that the market appears bullish, into clear, actionable rules. Specifically, a trader might decide to only buy stocks when their downside risk is still favorable after accounting for costs. Furthermore, decision bands provide a structured way to assess the performance of various trading strategies. By adjusting the thresholds, traders can test how changes affect their trading frequency, success rate, and overall profitability. This allows for a more informed evaluation of strategies, helping to identify the ideal balance between caution and opportunity. As we move forward to the next cell, we can expect to delve deeper into how these concepts can be operationalized in real trading scenarios, incorporating specific metrics and visualizations that can aid in making informed decisions. Cell 2. In this cell, we're setting the groundwork for analyzing Microsoft's stock prices and their returns. By importing essential libraries and retrieving historical data, we can prepare our dataset for further exploration. This step is crucial because it lays the foundation for understanding how stock returns behave over time, which can inform our investment decisions. We start by importing necessary libraries like NumPy, YFinance, and Pandas. These tools will help us manage and manipulate our data efficiently. Next, we specify MSFT as our ticker symbol, which represents Microsoft. Using the YFinance library, we download stock data starting from January 1st, 2015. Notably, we enable auto adjustment to ensure that our prices reflect stock splits and dividends for accuracy, while also suppressing progress messages to keep our output clean and focused. As we process the data, we isolate the close prices of the stock. If it turns out that our retrieved data returns as a data frame rather than a series, we ensure we're taking just the first column. This careful handling makes sure we end up with a straightforward series of closing prices. Afterward, we drop any missing values and assign a more meaningful name to our series for ease of use. Next, we compute the daily percentage change in the closing prices, effectively capturing the daily returns. This helps us understand how much the stock price changes relative to the previous day. We then shift these returns forward by 1 day to create a forward-looking return variable, allowing us to analyze potential future price movements based on past performances. Finally, we stitch all of this data together into a single data frame that includes the closing prices, daily returns, and forward returns, while removing any remaining missing values. It's a comprehensive dataset, ready for our analysis. Observing the shape of this data frame and inspecting its head gives us context about the structure and contents, setting the stage for deeper insights. Looking ahead, the next cell will likely delve into more advanced analysis, perhaps exploring trends, volatility, or even building models based on these returns to forecast future stock performance. This will enrich our understanding of market behaviors and help us make more informed decisions. Cell 3. In this cell, we're venturing into the world of finance analytics by calculating a rolling bootstrap confidence interval for the expected next-day return of a stock, specifically Microsoft, which is represented by the ticker symbol MSFT. This process is critical because it helps investors understand the potential fluctuations in returns over time, providing crucial insights for decision-making, especially in volatile markets. We begin by setting some foundational variables. The look-back period is established as 252 trading days, which roughly corresponds to 1 year of market activity. We've chosen a 95% confidence interval, represented by an alpha of 0.05, and plan to perform 2,000 bootstrap samples. This number can be adjusted. Increasing it typically results in smoother confidence intervals, but at the cost of computational efficiency. We also account for transaction costs and define parameters for allowing short trades, which can impact our strategy's effectiveness. The core of the logic lies in the bootstrap technique, encapsulated in the function defined here. This function takes a data array, samples it to create multiple means, and calculates the mean return along with the lower and upper limits of the confidence interval. It's important to note that if the dataset is small, particularly fewer than 30 observations, the function gracefully returns nans, indicating insufficient data for reliable inference. Next, we loop through our data frame containing past returns, extracting rolling windows of data based on our lookback period. For each window, the mean return and confidence bounds are calculated and stored in new columns in our data frame, explicitly named mu-hat, CI-low, and CI-high. This structured approach allows us to see how the expected returns fluctuate as we move forward in time. Finally, we display a glimpse of our updated data frame to visualize these mean returns and their confidence intervals. With this setup, we're well prepared for the next steps in our analysis, which will likely involve using these confidence intervals to evaluate trading signals or risk levels. Cell 4. In this cell, we're creating trading signals based on the decision bands we've established earlier, and then conducting a backtest to see how this strategy performs when factoring in transaction costs. The goal is to generate actionable signals that tell us when to take a long or short position, and to evaluate the impact of these trades on our portfolio over time. The logic here begins with initializing a signal array, where we set the default value to 0, indicating no position. Then we check if the lower bound of our confidence interval is confidently above a specified threshold, referred to as min edge. If it is, we assign a value of 1, signaling a long position. If short selling is permitted, which we control with a Boolean variable, we then assess if the upper bound is below the negative of min edge, and assign a value of -1 if it meets that condition, signaling a short position. Next, this signal feeds into our portfolio positions, which will reflect where we want to be invested as the trading day closes, setting the stage for calculating returns based on future price movements. Moving on to the backtesting section, we track changes in our portfolio position by shifting the current position data, allowing us to determine when a turnover occurs. This turnover is crucial as it accounts for transaction costs, which can significantly affect net returns. The calculations for strategy returns are done gross and net. The gross return is simply the product of our position and the forward return, while the net return deducts our transaction costs based on turnover. Finally, we accumulate both gross and net returns over time and compare them to a simple buy and hold strategy, which provides a benchmark for our trading approach. Displaying the head and tail of the data frame allows us to visually assess both the initial and final states of our calculated metrics, showcasing how our trading strategy has evolved. Looking ahead, the next cell will likely delve into a more detailed analysis of these results, examining performance metrics to gauge the effectiveness of our trading signals. Cell 5. In this cell, we're calculating some key summary statistics for investment strategies, specifically examining the net return from a decision band strategy and a buy and hold approach. Understanding these metrics is crucial because they provide insight into the effectiveness and risk associated with our strategies, helping us make informed decisions going forward. The function defined here, ANDStats, takes in a pandas series representing returns and calculates annualized return, annualized volatility, and the Sharpe ratio. Dropping any missing values ensures that our calculations are based on valid data, and there's a safeguard against processing insufficient data, as it will return an empty dictionary if there are fewer than 30 data points. The annual return is derived from the mean of the returns, raised to the power of the number of periods, typically set to 252, representing trading days in a year, then subtracting 1. This provides a sense of the compounded growth from the average daily return. Meanwhile, the annual volatility is calculated via the standard deviation of the returns multiplied by the square root of the period, giving a standardized measure of risk. The Sharpe ratio is defined as the ratio of annualized return to annualized volatility. If volatility is 0, we safely return an AN to avoid division by 0. These calculations are run separately for both the net returns from our decision band strategy and the forward returns from a buy and hold strategy. Finally, we print the calculated statistics for both strategies, providing a clear comparison of their performance. Additionally, we analyze the distribution of signals used by the strategies, enlightening us further on the nature of our trades. In the next cell, we are likely to take these insights and delve deeper into performance evaluation, or potentially explore how varying these strategies could impact the statistics gathered here. This could help us refine our approaches even further. Cell 6. In this cell, we're visualizing important financial metrics related to our trading strategy, specifically the rolling mean return and its confidence intervals. This visualization is crucial, as it helps us understand both the expected performance and the uncertainty around those expectations, guiding our trading decisions. To start, we create a scatter plot for the rolling mean return, denoted as mu hat, which reflects the average daily returns from our data over time. This trace provides a clear visual representation of how the expected returns evolve, helping us identify trends and potential shifts in performance. We enhance this by overlaying two additional traces that represent the lower and upper bounds of our confidence intervals, labeled as CI low and CI high. These bands give us a visual indication of the uncertainty regarding our rolling mean, crucial for risk management. Next, we introduce horizontal dashed lines at both the positive and negative thresholds defined by min edge. These lines serve as decision bands, marking significant levels that inform us whether our trading strategy should be considered robust or potentially risky. Additionally, we highlight trade days in the plot using markers. These trade days are identified by checking where turnover exceeds zero, helping pinpoint specific instances where position changes occurred. As we finalize the layout, we ensure the plot is labeled effectively, with clear titles for both the axes and the overall graph that indicate what we're visualizing. This attention to detail improves the interpretability of the data, making it more accessible for anyone reviewing the analysis. The chosen dimensions of the plot further enhance clarity and focus. Looking ahead, the next cell will likely delve into interpreting this data more deeply, perhaps assessing the implications of the rolling mean and confidence intervals on our trading strategy. This will help us understand how to apply these insights to make informed decisions in real-world trading scenarios. Cell 7. In this cell, we're delving into a powerful technique called quantile gradient boosting, particularly its application in predicting tradable price levels for the SPY, which is the ETF that tracks the S&P 500. This methodology is not only pertinent for traders seeking actionable insights, but also serves as a robust foundation for statistical predictions. We start by pulling the SPY data from Yahoo Finance, ensuring we have the necessary historical information to work with. From this data, we craft finance-specific features that are essential for our models. These features include elements like momentum, which helps us gauge price direction, volatility, indicating the potential risk involved, and drawdown, which showcases past performance in the face of declines. We also incorporate an indicator similar to the Relative Strength Index, or RSI, to further enrich our dataset. Next, we embark on training 3 separate gradient-boosting quantile models. They will predict the next day's return at specific quantiles: the 10th percentile for downside risk, the 50th percentile for a neutral expectation, and the 90th percentile for upside potential. The logic here is straightforward. By estimating these quantiles, we're effectively creating a framework that allows us to anticipate price movement with greater nuance. After modeling, we convert these return quantiles into actual next-day price levels, harnessing the output from our quantile predictions. This transition from theoretical returns to concrete price levels is crucial for practical trading decisions. Finally, we'll visualize these outcomes using Plotly, which provides an intuitive and interactive way to analyze the data. There's also an optional component where we can implement a simple decision band rule. This rule could potentially guide traders on when to enter or exit positions based on the quantile's interpretation. As we move forward, the next cell will likely build on these quantile predictions, possibly integrating them into more comprehensive trading strategies or refining our feature set to enhance accuracy further. This progression promises to deepen our understanding of market dynamics and our predictive capabilities. Cell 8. In this cell, we're diving into the initial stages of data preparation and feature engineering for our stock prediction model focused on Microsoft. This aspect is crucial because the quality of our input variables can significantly impact the accuracy of predictions we'll make later on. To begin, we gather Microsoft's historical stock data, specifically the closing prices, starting from January 1st, 2015. Utilizing the Yahoo Finance library, we efficiently download this data, ensuring that only the closing price is retained after any potential adjustments. At this point, we also ensure that any missing data is dropped, and we rename our series for clarity. Next, we construct a data frame that not only houses the closing prices, but also incorporates daily returns, calculated as the percentage change in closing prices. This return metric serves as a foundational element for our subsequent analysis, allowing us to measure stock performance over time. Moving into feature engineering, we create several important features that can help our predictive model gain more insights. First, we calculate momentum indicators for different time frames: 5, 20, and 63 days. These metrics will help us capture how quickly the stock price is changing. We also compute the realized volatility over 20 and 63 days, which quantifies the degree of variation in the stock's returns. This gives us an understanding of the stock's stability and riskiness. Further, we analyze drawdown features by identifying the maximum price over the past 63 days and comparing the current price against that maximum. This helps us gauge how far the stock has fallen from its peak, offering another perspective on risk. The Relative Strength Index, or RSI, adds yet another layer of analysis, helping us identify potential overbought or oversold conditions in the stock's price. This is accomplished through a function that computes the gains and losses over a 14-day window, revealing how the stock behaves in reaction to its past price movements. Lastly, we incorporate calendar features such as the day of the week and the month, recognizing that market behaviors can vary significantly based on these temporal factors. Our target variable, labeled as Y, represents the next day's return. This is what we ultimately want to predict. With the data frame finalized and enriched with these features, we're setting a solid groundwork for the machine learning model to come. The next cell will likely take these engineered features and move into the model training phase, where we'll apply a powerful algorithm to predict future stock performance. Cell 9. In this cell, we're diving into a more sophisticated approach for forecasting, utilizing a walk-forward training strategy combined with quantile regression models. This method is particularly important because it helps avoid any potential leakage from future data, creating forecasts that adapt to the dynamics of the dataset over time. To start, we're defining a set of features which are relevant to our forecasting. These include momentum indicators, volatility measures, drawdown, and seasonality elements like the day of the week and month. The input data is then neatly organized into arrays for both features and target values to facilitate model training. The look-back period spans 3 years, reflecting our intention to base predictions on substantial historical data, and we aim to refit our models approximately every month. The predicted outputs focus on 3 quantiles, the 10th, 50th, and 90th percentiles. This gives us a robust view of different possible future outcomes, which can be particularly valuable in volatile markets. We initialize a dictionary to store predictions for each quantile, ensuring that we maintain clear organization as we build our models. The function defined here, make_QGB, sets up our gradient boosting regressor for quantile regression, allowing us to specify different quantiles for our training. Notice the adjustments in model parameters tailored for performance. For instance, we've reduced the number of estimators to speed up the training process, while slightly increasing the learning rate to compensate for this change. As we move through the data, the loop dictates the workflow. We're systematically breaking it into training and testing sets based on the specified lookback and step sizes. Each quantile model will be fitted to this rolling window approach, providing a comprehensive forecast for the defined quantile intervals. The final outputs are added back into our original data frame for the relevant predicted values, and we calculate adjusted price levels based on these quantiles. Notably, any rows with insufficient data for predictions are elegantly handled by dropping them. As we look ahead to the next cell, we'll likely explore how these quantile forecasts can be applied in practical scenarios, possibly examining strategies that leverage different quantile outcomes for decision-making. This step is crucial in connecting our model's predictions to actionable insights in trading or investment contexts. Cell 10. In this cell, we're creating a visual representation of predicted next-day price levels for a particular financial asset using a quantile-based approach. This is vital for traders and analysts, as it allows them to gauge potential price ranges, providing insights into volatility and possible outcomes based on current prices. To begin with, we focus on the most recent data, taking a snapshot of the last 800 entries. This enables us to work with the latest trends while ensuring that we're only analyzing relevant information. We then initialize a figure using Plotly, which will be our canvas for plotting the price data. The first trace we add showcases the actual closing prices, providing a baseline for comparison. Following that, we introduce 2 additional traces representing the next day predicted levels, specifically the 90th percentile and the 10th percentile. These values are critical because they help illustrate the range in which we might expect the next day's price to fall. To enhance the clarity of our visual, we fill the area between these 2 predicted levels. This creative touch allows viewers to quickly grasp the variability of prices, where the shaded region represents a predictive band that encompasses 80% of potential outcomes. It's important to understand that this isn't a confidence interval, rather it's a practical tool that traders can use to make informed decisions. Additionally, we plot the 50th percentile line, which represents the median next day price level. This offers a further point of reference for what one might expect in the market. Once all traces are added, we customize the layout, setting titles for clarity and adjusting dimensions for optimal viewing. Our visual is now ready for display. It's designed to provide immediate insights about where prices may land based on the statistical forecasts we've calculated. In the next cell, we will likely delve into more detailed analyses or perhaps explore further metrics to supplement these predictions, thereby enhancing our trading strategies. Cell 11. In this cell, we're developing a trading strategy that accounts for transaction costs while determining optimal buying and selling prices. This approach is crucial because incorporating costs into our trading decisions can significantly impact profitability. First, we define key values related to transaction costs, which include a constant representing the cost of making a trade and a minimum edge that we want to maintain. These values help us establish a hurdle that dictates the minimum price movement necessary to justify entering or exiting a trade. This hurdle is calculated by combining our transaction cost with a safety margin, indicating how much the stock needs to move to make a trade worthwhile. Next, we grab the latest available data from our data frame, specifically the current closing price and the 10th, 50th, and 90th percentiles, which represent different possible price points for the following day. This data gives us essential reference points to determine potential entry and exit levels. After that, we compute the hurdle in dollar terms, which tells us exactly how much the price must change to cover our costs. With this figure, we can establish concrete buying and selling prices, where we suggest buying if the price falls below the buy threshold and selling above the sell threshold. If the price is within a certain range, we recommend holding on to the asset. As a final check, we assess the current price against our established thresholds to determine an actionable strategy. Depending on whether the current price is less than the buy price, more than the sell price, or in between, we'll decide if we should buy, sell, or hold the asset. Looking ahead, the next cell will likely delve deeper into how these decisions can be visualized or tested in a more dynamic trading environment, further refining our strategy based on live data and performance metrics. Cell 12. In this cell, we're shifting our focus from simple point forecasts to a more nuanced approach, distribution-aware forecasts. This change is significant because it provides a clearer view of market uncertainty, allowing us to make informed trading decisions rather than relying on averages that can be misleading. Here, we're looking at three key quantiles: the 10th percentile, the 50th, and the 90th. These quantiles represent predicted return levels for the next day. For instance, Q10 indicates a conservative estimate of returns, while Q90 reflects a more optimistic scenario. The actual price levels we expect to observe are denoted as P10, P50, and P90, with the range between P10 and P90 functioning as our uncertainty envelope, essentially defining the bounds of what we might expect. The trading rules established here hinge on the edge between expected returns and associated costs. For a trade to be justified, we need a compelling case. When considering costs, a positive return must exceed what we estimate even at the 10th percentile. Conversely, if we're considering a short position, we require assurance that the 90th percentile return remains negative after accounting for those same costs. This creates a very stringent requirement for confidence in our trades. What this ultimately implies is quite revealing. It suggests that most market conditions don't offer enough guarantee of a positive outcome, which reinforces the idea of efficient markets. Essentially, the model conveys a sobering reality. We can't always count on favorable outcomes, reflecting the unpredictability inherent in financial trading. As we transition to the next cell, we'll likely explore how to operationalize these insights, maybe by incorporating decision-making frameworks that align with the confidence levels we've identified here. Pushing forward our analysis into practical trading strategies. Cell 13. In this cell, we delve into visualizing the relationship between enter and exit thresholds using a heat map, specifically focusing on how these factors influence the Sharpe ratio. This visualization is pivotal, as it not only aids in understanding the performance of trading strategies, but also highlights optimal decision bands, showcasing where our strategies perform best. The code starts by transforming the results into a pivot table, where the index represents the exit hurdle, the columns correspond to the enter hurdle, and the cell values reflect the calculated Sharpe ratios. This structured format is essential for effectively visualizing the interdependencies between these two variables. By employing Plotly Express, the cell creates an image that seamlessly illustrates these relationships. The heat map is generated through the imshow function, which allows us to display the matrix of Sharpe values in a more digestible form. It's organized with the x-axis denoting the enter hurdle and the y-axis for the exit hurdle. The color scale represents the Sharpe ratio, providing an intuitive grasp of performance across varying thresholds. The layout is further refined for optimal viewing, ensuring that the heat map is not only informative, but also visually appealing. A crucial assumption here is that the data in the res variable is accurately calculated and represents the relevant trading strategies. Learners should also note that interpreting this heat map requires a good understanding of what the Sharpe ratio signifies in a trading context. Higher values indicate better risk-adjusted returns. As we examine this heat map, we gain insights into how tweaking entry and exit points can significantly affect our trading outcomes. Moving forward, the next cell is likely to build upon this visual analysis, perhaps diving deeper into the implications of the findings or exploring additional metrics to further refine our understanding of strategy performance. Cell 14. In this cell, we're creating a scatter plot to visualize the relationship between the Sharpe ratio and the number of trades made during an investment period. This visualization is significant because it allows us to assess how trading frequency and performance interact, giving us insights into the efficiency and risk-return profile of a trading strategy. Here, we use the Plotly Express library, which makes it straightforward to create dynamic and engaging visualizations. In this scatter plot, we've set the x-axis to represent the number of trades, while the y-axis displays the Sharpe ratio, a crucial measure of risk-adjusted return. Each point on the plot corresponds to a specific trading strategy or scenario captured in a dataset, referred to as res. The color of each point indicates the percentage exposure in the market, and the size of each point reflects the total return from that strategy. This multidimensionality allows us to analyze not just the trade-off between Sharpe and trades, but also to gauge market exposure and returns simultaneously. The use of hover data enriches the plot by providing additional metrics, such as entry and exit hurdles, total return, and market exposure percentages, which can enhance our understanding as we examine each strategy. When interpreting this scatter plot, we should consider how these variables interact. For example, a high number of trades combined with a low Sharpe ratio may indicate a potentially risky strategy that requires careful evaluation. However, it's also important to remember the potential for outliers or misleading correlations, which could skew our interpretations. This means taking a measured approach when drawing conclusions from the visual data. Looking ahead, the next cell will likely build on these insights, possibly diving deeper into specific strategies highlighted in this plot, or exploring how different market conditions might affect these relationships. This foundational understanding of trade-offs in performance will help us advance in our analytical journey. Cell 15. In this cell, we're developing a structured strategy for trading that incorporates specific entry and exit points. This approach acknowledges the complexities of financial transactions, particularly the impact of expected profit, uncertainty, and transaction costs. By formalizing these elements into a clear no-trade zone, we're better equipped to make informed decisions, which is a critical aspect of successful trading. The essence of this analysis is to define 3 distinctive regions that dictate our trading actions. The first region indicates that when the expected profit is less than transaction costs, the best course of action is simply to refrain from trading altogether. This helps avoid unnecessary losses that could arise from transactions that aren't financially beneficial. The second region highlights scenarios where the potential profit exceeds costs, prompting us to buy, as this indicates an advantageous position. Conversely, the third region focuses on situations where expected losses exceed the costs, suggesting that selling or shorting is the more prudent choice. What sets this approach apart from more naive strategies is its reliance on conditional participation, rather than a perpetual presence in the market. Instead of simply considering the mean forecast, we factor in the entire distribution of outcomes, leading to more nuanced decision-making. Additionally, this method takes costs into account, promoting a more selective trading style that minimizes overtrading, which can often erode gains. Essentially, we're aiming for a robust trading strategy that withstands market volatility, instead of a fragile one that may falter under pressure. As we move forward to the next cell, we will likely delve deeper into the implementation of this no-trade zone concept, perhaps visualizing these regions or quantifying the impact of different trading signals. This will enhance our understanding of how these principles apply in real-world scenarios. Cell 16. In this final cell, we're wrapping up our analysis, marking the completion of our exploration. It's essential to reflect on what we've accomplished and consider how the insights gained will guide our next steps. At this stage, we have gathered valuable data, processed it, and drawn meaningful conclusions. This cell emphasizes not just the end of our current tasks, but also the importance of what we've learned throughout this notebook. We've dived deep into the relationships and patterns within our dataset, ensuring that any assumptions were carefully scrutinized. One thing to keep in mind is that while this marks the end of our current analysis, it also lays the groundwork for future inquiries. Any findings can serve as a springboard for further research or new questions to investigate. This iterative nature of data science emphasizes that even when one task is complete, new opportunities are always on the horizon. By wrapping everything up here, we're setting ourselves up for future projects that might require a similar methodology or exploration technique. So, as we transition to what comes next, let's remember that every conclusion is merely a stepping stone to a deeper understanding or a new direction. In the upcoming cells, we will likely build on this foundation, possibly by applying what we've learned to new datasets or different analytical methods.